This is the performance of the S&P 500 year to date, so from January to when I'm filming this, up 12.13% in 9 months or so. And if I zoom out a bit further look and go back to a full 12-month period, it's even better, up 16.57%. Surely it can't always be this good, right? Let's zoom out even further and look at the last 5 years. Let's bring a bit of that COVID market turmoil into the mix. That'll sort it out. Oh, up 48.60%. I mean, if you want to take this to the absolute extreme and zoom right the way out, wow, look at that, up 2,410%. That's all the way back to October 1983, so a nice round 40 years of data. So look, I get it. I can see why it's a popular index to track, and I know that some of you out there have all your chips in on this market, which is a bold move to say the least, even with this backdrop of long-term positive returns, because there's something I think a lot of people misunderstand, or at very least don't take into account, especially when this forms the entirety of their investment portfolio. I think this index is riskier than you realise, and in this video, I'm going to explain why. For those of you that I've lost already, the S&P 500 is simply a list of the 500 largest companies in the US. Which sounds simple, doesn't it? But where it gets a little more complicated is the fact that it is a market cap weighted index. What the hell does that mean? Yeah, I know. Let me explain. Market cap, or market capitalization, to give it its proper name, is a way of measuring a company's size. It's calculated by multiplying how many shares there are by the share price. And the answer it spits out is, in theory, the total value of the company. So if that finance show PLC has 10,000 shares in existence and one share is worth $100, my business is worth $1 million. And to think they say I use unrealistic examples. So what happens in a market cap weighted index like the S&P 500 is that the companies with the biggest market cap, so the companies worth the most money, have the biggest impact on how the index performs overall. And boy, has this been happening in the S&P 500 in a big way recently. This article from a bit earlier this year, back in May, when the S&P 500 was up 8% year to date, was keen to point out that actually most of the stocks in this index were in fact down. But perhaps more interestingly, this article from the 1st of June discusses how 5 companies alone have driven the performance of the S&P 500 this year. At the time of the article, the index was up 8.9%, but the top 5 companies were up a whopping 56.2%. So who are these 5 companies that are dragging the other 495 kicking and screaming behind them? Well, it's Apple, Microsoft, Alphabet, Amazon, and Nvidia. Nvidia in particular has had a crazy run. Look at this, 213% up year to date. How mad is that? If you were to take out the other 2 big tech contributors in the index, which are Meta and Tesla, the S&P 500 would actually be posting an overall loss in 2023 at the time of this article. So we've got big tech companies that take up a disproportionate amount of the index, delivering most of the performance. So make no mistake, when you choose to solely invest in the S&P 500, you are choosing a pretty heavily tech-driven portfolio, and I don't think enough people understand this. People often try to explain to me how diversified their portfolio is because they own 500 companies, and as you can see, it isn't really this straightforward. They think they own an equal slice of each of the 500 companies in the index, and they don't. Yes, it's gone well the last few years, but what happens if an AI robot goes AWOL and comes after Sarah Connor? That will not only be bad news for planet Earth, because Arnie's surely too old to save the world now, but your portfolio will be slowly lowered into hot lava too. It's fragile. You're pinning your hope on fewer stocks than I think people realise. If one of those big 5 has a disaster, you're going to feel it. These 5 firms currently represent nearly a quarter of the index as shown here. If when you look at an index and let's say it's performed well, when you drill down, if the majority of the stocks have done well in that index, which has led to the good performance, then that's an indicator of a strong market. If, on the other hand, most of the stocks in a rising market are in fact struggling and the whole thing is being propped up by a few big winners, you could be on seriously shaky ground, which is kinda where we're at. But there are reasons to be optimistic too. For example, although this tech rally will have some people worried we have another dot-com bubble ready to burst, it actually feels very different to that. The concentration of returns were even higher back then, for one thing, and a lot has changed over the last 25 years or so, meaning there are much more fundamental reasons why tech companies are doing so well. Well, they're actually making money, for one thing. The irony of the situation is that there were lots of economists, market predictors, tea leaf analysts, and tarot card experts that all said, with rising interest rates, the one industry that was going to really struggle was big tech. And look how wrong they were. I got called into a meeting last week about what I think the performance of my clients' portfolios are going to be over the next 6 months. Big boardroom, booked out for a full hour, sandwiches, posh coffee pod machine thing, the works. I sat there and I simply said 2 words. No idea. I've no idea. It's the truth, not a clue, and I'm happy to admit that, and I do this for a living. All I know is that if you invest for long enough, diversify well enough, and manage your emotions along the way, you'll do all right. But perhaps even more crucially, make sure you understand what you're investing in.